Hi, in this video, I want to share with you a very simple strategy that will work even for beginners. It is based on just two very popular indicators. It is very easy to understand and its signals are not ambiguous. You can identify them accurately. And it's very useful for beginners who may be confused by other strategies. It is a specific strategy, very visual and with very accurate signals, with a signal passability of more than 60-70%. And let's move on to its consideration. We need only two technical indicators for the strategy. These are Bollinger lines and RSI indicators. Let's add them initially to the chart. Here we have a completely empty schedule. Now we can add the two indicators we need. Let's start with Bollinger Bands. It is a relative range indicator, a volatility indicator. It shows how volatile the market is at a particular moment, how much trading volume there is in the market. It consists of three lines. In the middle of this line is a moving average. It's just a regular moving average that shows the average of the previous sum period. In this case, the period is 20, the standard for Bollinger Bands, and those strips on the sides are the Bollinger Channel. It shows volatility. If it is wide, it shows that there is trading volume and volatility in the market. If the Bollinger Channel is narrow, here for example, it is relatively narrow. This means that the market is calm and the chart is trading within a very narrow range, with no sharp spikes. The Bollinger Channel is good because it not only shows volatility, but it also acts as dynamic support and resistance levels. For example, when the chart touches and goes beyond the upper boundary of the Bollinger, this is not a bad signal to trade down. And when the chart touches the lower boundary of the Bollinger, it is a signal for an uptrade. Of course, these are not perfect signals, and it is very problematic to use only Bollinger Bands separately from other indicators, because there will be a lot of inaccurate signals, and in reality, it works well only in flat. Therefore, to filter its signals, we will install the second indicator. It is the RSI indicator, Relative Strength Index. This is an indicator that shows oversold and overbought moments on a chart. When the RSI line approaches the lower boundary, it is called an oversold zone. This means that the asset is trading lower than the average for the calculation period. In this case, period 14. That is, at this point it shows that the chart is trading lower than the average of the previous 14 candles. The upper boundary is called the overbought boundary. This means that the selling has been going on for a long time. There was an upward trend, and now the chart is trading higher than the 14 candle average. When we talk about trading, we talk about the fact that the chart always tends to average out. There are upward and downward deviations, but the chart will tend to its average and normal value, which means that from the oversold line, we usually trade upwards, and from the overbought line, downwards. Note that we need non-standard indicator settings. For Bollinger Bands, we set the period 30. That is, we will count the average for 30 candles, and we leave the period indicator at 2. Here's a rebuild now on 30 candle Bollinger Bands, and we need an RSI indicator with a period of 13 so that it counts the average of 13 candles. So the indicators are set. Now we can move on to the strategy signals. So the strategy in a buy signal is considered when the chart touches the lower boundary of Bollinger Bands. He ran it down. This is the first signal, but we have to filter through the RSI indicator. And the indicator at the same moment should show us the oversold level. And if these two signals coincide, we enter the trade upwards, as, for example, here. Right here, right now, another signal is forming right now. If the Bollinger Bands chart has already gone beyond the upper line, it is already a signal for a trade down. And if the RSI indicator crosses the overbought line, we can enter a trade down on this chart. Let's look at the opposite example. This is an example of a trade down. For a trade down, we should have the opposite situation. We have the RSI indicator should be above the upper Bollinger boundary. It should break the Bollinger boundary upwards, and the indicator should show overbought. That is, that the chart is relatively high and should go down soon. Right now, we've got both signals at the same time. We simultaneously have a chart above the Bollinger, and the RSI indicator is showing and confirming a down signal. But here I want to show two examples of how these indicators mutually ensure each other. For example, at this point, we have an overbought condition. The RSI indicator is showing a downward bounce, and the chart on the Bollinger channel does not reach the top line. So we have no confirmation from the Bollinger indicator. So this is the kind of signal we miss, and here we have the opposite situation. We have a chart above the Bollinger level. That is, there is a basic signal, but RSI does not confirm it. As you can see, there would be an unfortunate signal here. Therefore, it is critical for us that these signals appear at the same time. An important point is that the strategy performs quite poorly in trend movements when we have a sharply rising trend or a sharply falling trend. In this case, the chart will be either overbought or oversold for a long time, and there will be a lot of inaccurate signals. The chart shows itself best in flat, when there is no clear trend, when we have price fluctuations up, down, between resistance support levels. Under such circumstances, the strategy will yield very high performance. So before you trade the strategy, you make sure you look to make sure there is no clear trend on the chart. We are only looking for flat charts, and after that, we can move on to trading this strategy. Another important point is that the higher the time frame you trade on, the more accurate the signals will be. They will appear less frequently, but they will also be more accurate. Conditionally now, a time frame is worth 5 minutes. Each candle shows the result of trading for 5 minutes. But if we set 1 hour or 4 hours, the signals will appear later, of course, simply because the candles will appear less frequently. But in doing so, the signal will be longer term and stronger. Be sure to try this strategy, test it on history, see how it worked before. You'd be surprised how accurate these are for technical analysis trading signals, and be sure to try this strategy in your trading.